Hey everyone, welcome back to the channel, your number one source for income-oriented investing. It's been a crazy couple of weeks, and today it's time to go over the income-oriented landscape in America and the US. So this is for my American friends, obviously, and for those Canadians who invest in US-listed ETFs, for example, in their RRSP. So let's go over, see what the stock market did in the last month. It hasn't been pretty, but I am filming this on April 11th at about 2 p.m. The market is pretty positive today. Of course, the session is not over, but if we just zoom out to the last 1 month, it's obviously been very negative. So S&P 500 down 4%, NASDAQ 100 about 4% the last month. That seems a lot less than I thought it would be, but I guess it's because of the recovery today. It went up, going up 1% today. I think the all-time high was 22,000 for the NASDAQ, which is just ridiculous, right? It's so funny, and nobody ever complains about this, right? The NASDAQ just going up and up and up and up like crazy. But then when it corrects a tiny bit, which in my opinion was definitely due, everyone screams and yells. But that's just the name of the game. So yeah, negative as well for the last 1 month. Same thing for the Russell, same type of story, even more so, small caps, right? Probably even more, get more impacted than big caps when there's things like tariffs and global news, because they just don't have the power and the defense of the big boys, of the big caps. So Russell 2000 down fairly significantly. So what we'll do as usual, guys, is go over the entire income landscape. We'll start with the S&P 500 style ETFs and S&P 500 index cover call ETFs, then the NASDAQ, then the Russell, and then the alternatives like Bitcoin and sector specific as usual. So let's get started. Before we continue, I'd like to thank the sponsor of this video, Fire ETFs, which is a brand under the Tidal Financial Group umbrella. So they have an ETF called FIRES, FIRS, specifically designed for the FIRE community, where you're actually in your wealth building phase. So it's called the FIRE Funds Wealth Builder ETF. And this is actually an ETF that has been designed to withstand multiple market condition, like it says here, or changing economic environments, because it's very well diversified within all asset classes. So as you can see here, if we look at the top 10 holdings, this is actually an ETF that holds multiple ETFs, and we're talking about bonds, we're talking about S&P 500 stocks here, gold, a little bit of Bitcoin as well, some REITs as well. So if you're looking for an ETF that's very diversified and that's able to withstand multiple market conditions, where you're trying as an objective growing your wealth, this could be one to consider. So again, thanks to Tidal Financial Group for sponsoring this video. Okay, so let's start with JEPI, of course, still the biggest and popular one. We're going with the S&P 500 variance, I would say. So JEPI, latest distribution in April, a little bit higher. That's normal, right? Volatility is a bit higher. I expect next month's. I can't wait to see the ones next month. I'm assuming they could be very drastic. I'm expecting a lot of them to be much higher. So yeah, that's JEPI for you. This is we'll see the performance in a little bit, but JEPI's been doing actually really well lately with the volatility, because JEPI, like I've been saying, is more of a defensive S&P 500. You have Bali, which is JEPI's BlackRock competition. They also had a pretty big distribution increase from 20 cents to 25 cents. Of course, we know these will vary monthly, and Bali is an S&P 500 style. It's not exactly the index, but it's big cap US stocks. Then you have YMAX, which is for maximum income. This is just combines the yield max universe. The yield is always really high with this one. Latest distribution at 12 cents, but this is weekly. They could vary substantially. And then you have the S&P 500 equal weight, which also has been doing better than the regular one, market cap weighted, because as you guys saw, the biggest companies to be impacted were really the big cap tech stocks, which make up a big portion of the S&P and the NASDAQ. But if you have an equal weight where they have much less percentage, obviously it could outperform the regular market cap weighted S&P 500. I don't think it will do that over time, but just in a short period of time. And the tail is in the total returns. As usual, guys, we'll compare these ETFs here, and you could really see the difference in the short term. You see in the short term that JEPI and RSPA are definitely outperforming because they're really more defensive. They're and by the way, RSPA, Bali, and JEPI are all outperforming the S&P 500 in the last 3 months. You see that. YMAX is not. It's down a lot more. We know that YMAX has a lot more exposure, a lot more percentage in those more volatile technology stocks. And that's probably why. Moving on to the classic S&P 500 covered call ETFs. This is the actual S&P. You have XYLD, which gives up all the upside. This is writing 100% covered calls, rinse and repeat every single month. I know usually I don't cover it, but as I suspected, the distribution, when volatility goes up, you got to expect a distribution increase as well. I love how they show the volatility. Of course, it's not coming up now. I don't know why. But you should, there we go. You see that I expect next month it's going to be even higher here. So that's XYLD. If you basically don't like the S&P 500, you think it's going to go down, this is the one you're going to get, right? Because it's writing covered calls on everything, which means you're giving up all the upside. In terms of super standard, classic, can never go wrong, you have GPIX from Goldman Sachs. And, still very consistent distributions. Let's look at the latest one here, 34 cents, very, very consistent monthly distribution. Same thing for SPY-I, very consistent, approximate 12% yield on the S&P 500 one. Just did a long and good Q&A with Troy Cates, the guy who manages these ETFs on NEOs. Make sure to check out that video because if you own SPY-I or any one of the NEOs covered call ETFs, you definitely want to see that Q&A. And then there's the lowest fee S&P 500 ever by BlackRock, the rinse and repeat iShares S&P 500 buy right ETF, which just does 1% out of the money call, rinse and repeat every single month. So it's kind of similar to XYLD, except XYLD is at the money. This is 1% out of the money. So they both write a lot. Basically, they both give up a lot of upside, and you see the latest distribution absolutely through the roof here at 80 cents versus 32. But they had big distributions before, right? $1. These vary greatly. And if we look at the total return between these last ones that we just checked out, and guys, this is, I'm using the Vanguard site. You can only really see 1 year. A lot of them, these three have not even been out for 3 years. I always recommend you do the total return comparison because it could be deceiving looking at the 1 year, right? Looking at the 1 year, you see XYLD is actually even beating the S&P 500, which is incredible. But if you actually do a total return since inception, it's not. So in the last 3 months, and this is a theme you're going to be seeing, if you understand covered calls and what they do, you'll understand this makes sense completely. The more covered calls you're doing during the bad time, the more you're going to do better than the S&P 500. That's why things like XYLD, IVVW, right, are doing a lot better than the S&P 500. Actually, all four of these S&P 500 covered call ETFs in the last 3 months are beating the S&P 500. Of course they are, because it's on a downward trend. So, right, the more covered calls you write, the more upside you're giving up, but the more premium you're taking in during the flat and down times. That's why you see, even I have to give it up to the guys at NEOS. They've been doing really well. Actually, the best out of the four right here. I'm assuming the best would have been maybe XYLD or IVVW, but hey, SPY-I, got to give it to them. Doing really, really well in the last couple of months here. Moving on to the daily ones, it's the same type of story, right? For the daily option covered call ETFs, you have WDTE, which just writes a crap load of covered calls for the highest amount of yield. You have SPY-T, which is an annual, which does a daily call spread, and they target 20% yield annually. You have XDTE, of course, with weekly distributions. And how the latest distribution? 21 cents. I thought it would be higher. We'll have to see in the next couple of weeks. I'm assuming, or I'm guessing that that the next couple of weeks are going to be a bit higher. And then, of course, you have, I believe, the lowest fee daily S&P covered call ETF, iSpy from ProShares. There's also T-Spy, which I have an upcoming Q&A with the CEO of Tap Alpha. Very, very interesting. T-SPY has been really doing well in terms of total return. And of course, you have SDTY as well, which is a newer one, which is, XDTE's competition. Very similar concept, right? Daily covered calls on the S&P 500. In terms of total return, I put them here. I didn't put the Yield Max one because it hasn't been out for a long period of time. And it's the same type of story. All of them are beating the S&P 500 in the last 3 months. Of course they are. But guess who's doing the best? Take a guess, guys. The one who does the most covered calls, and that's definitely WDTE. Why is it doing the best out of all of them? Because they're taking in the most premium. It's as simple as that. You could actually see which ones are taking in more premium if you compare it to the S&P 500. The better it does versus the S&P 500, likely the more calls they're writing. This is good during a flat and down market, but during a positive market, it's bad, right? Because you're giving up a lot of upside. This is why over the long term, the ones that write a lot more covered calls typically underperform more over the long term. But they will perform better during a short term. That's bad, right? So again, guys, just to make sure, right, because it looked like XYLD was doing phenomenal here 1 year. But if you do total return comparison since the beginning, for example, XYLD versus SPY-I, you'll see that, SPY-I is still outperforming XYLD versus GPIX. For example, GPIX is outperforming by a lot as well here. So yes, in the short term, right, the covered call ETFs that write a lot of covered calls do well, but over the long term, they seem, they underperform. Moving on to the NASDAQ ones now, we'll start with QYLD. I'm assuming it's going to be the same type of story, and maybe we'll see a bump in distribution next month because volatility has definitely spiked. We'll see the April one next month here. JEPQ, let's look at JEPI's NASDAQ brother, which I feel is definitely a lot more closer to the index than JEPI's. That's why I put JEPQ with the regular NASDAQ 100 ones. Nice jump in distribution. Not surprising. Volatility is higher, maybe even higher next month. We'll see for the May. Of course, you got your standard Goldman Sachs one, GPIX. Same type of deal with GPIX, right? X for the S&P, Q for the NASDAQ. Very consistent, a little bit lower than the last couple of months, but still very, very consistent here. You're looking at about 10-11% yield, something like that. Of course, QQQI from NEOS, right? NEOS has been doing really well, very consistent distributions as well. A little bit lower. We'll see next month. But I think right now the trailing yield is over 15%. So yeah, obviously you're going to get about 2% more yield than SPY-I because the NASDAQ's a little bit more volatile. You have Invesco's. They're the ones who actually manage QQQ and QQQM. They have their own covered call ETF now, QQA. These four I would put under the classic or standard NASDAQ 100 covered call ETFs. And if we check for the total return comparison here, let's go down, look at the total return between the classic ones. And again, guys, always make sure you use that tool for the total return since inception. But if we look here, it's kind of the same type of story here, that QYLD is down the least because it does the most covered calls. So it's 100% normal, right? Completely normal here. You have QQA, QQQI. You see the minuses here. This is versus the S&P 500. I wish they would have the NASDAQ 100 here. But of course, QYLD is going to outperform because it's giving up all the upside. But if you zoom out and look at 1 year plus, you know that GPIC and JEPQ is going to outperform, right? Daily ones, QQQY for a maximum income. For the daily ones here, QQQT, same concept as SPY-T with that 20% target. QDTE, of course. What's the latest weekly one? A little bit lower. Can't wait to see the next couple of weeks. IQQQ, of course, from ProShares. QDTY, again, the Yield Max one. If we do a total return comparison, you're looking at the same type of story. QQQY is doing the best in the last 3 months. Of course it is. It's down the least because it writes the most covered calls, right? So there's advantages and always disadvantages as well. The Russells, you got the IVVW brother, except it's 2% out of the money instead of 1% out of the money. So this is a rinse and repeat, 2% out of the money monthly call on the Russell 2000. Let's check out the latest distribution. Yep, pretty big, 63 cents compared to last month. You have the NEOS one, of course, which is at 15% yield with pretty consistent monthly distributions as well here. That's what NEOS is known for. You have IWMY. This is the daily, right? The daily maximum income one here. Daily Russell 2000 maximum income. RDT, ITWO from ProShares. Same ones, right? Same strategy, same providers, just on the Russell 2000. Did I do a total? Yeah, I did do total return comparison. And it's the same type of story. Guess who's doing the best in the last 3 months? The Defiance one, who writes, of course, more covered calls. So starting to get the theme now. And then we have GIAX from X Funds, which is under the title umbrella. This is really one that if you want daily options, but on a bunch of things that get kind of global exposure. Pretty consistent distributions, a little bit lower than the last month here. Here's the April one. So yeah, this again, guys, this is one if you want to diversify outside the US. It has a bunch of stuff, a bunch of ETFs in here. It's an ETF that holds a lot of ETFs. You know, see a lot of Vanguard ETFs to get you mostly US, but there's also stuff outside of the US. Like here's a Europe one, Israel, Argentina, emerging markets, etc. This is really if you want the global exposure. And last but not least, we'll move to the alternatives. SVOL took an absolute beating. So if you know SVOL strategy, the worst nightmare of SVOL just happened when the VIX spikes. There also has another similar ETF called ZVOL, which kind of does the same thing. So of course, the ETFs have really done bad. You see ZVOL minus 33% in the last 6 months, SVOL minus 27%. They're recovering a little bit. But yeah, I mean, SVOL, we'll see what the next distribution is. My assumption is it's going to be reduced from 27 cents. This is the worst case scenario. And if we just do, by the way, a total return comparison, SVOL versus ZVOL, I'm doing it because I know many of you are ZVOL fans. You see that SVOL is still outperforming since the first of 2024, January 1st, 2024. ZVOL is underperforming SVOL. We'll see what happens. But if you do hold SVOL, you know, you got to make a decision. My opinion is that you're probably better off with just an S&P 500 ETF, guys. That's what I would take instead of SVOL. For example, if you do SVOL versus SPY-I, you see that SPY-I is outperforming SVOL by a lot. GPIX even more. So if you hold SVOL, you kind of don't like what's happening now. To be honest with you, now might be a good time to buy some more and average down. But if you're scared of future big drops when volatility spikes, I would recommend maybe swapping your SVOL or your ZVOL to just a regular S&P 500 covered call ETF like we reviewed at the beginning. So moving on to the alternatives, of course, you still have YieldMax, which does a lot of max covered calls on a bunch of single names. They keep adding some. They added like a short MicroStrategy. They added semiconductor. They added their new zero DTE ones. There's Curve as well. If you know, they have an Apple, Amazon, Microsoft, Netflix, Google. Tesla single stock covered call ETF probably do a little bit less calls than YieldMax. In terms of sector, technology is definitely on sale, guys. So if you're going to ask me what's on sale, it's pretty much everything. S&P, NASDAQ, Russell, but you know, NASDAQ especially and technology especially because they're during a sell-off, they typically sell off harder and the quickest because they're considered the more riskier asset. So if you want to capitalize just on technology, you got FEPI, you got AIPI, which typically has solid, very high yield and consistent monthly distributions. We'll see what the next ones are. A little bit reduced for AIPI, the latest one. I'm assuming the same thing. Yeah, a little bit lower, but still very high and a good way to capitalize on just tech if you want. YieldMax has one as well called YieldMax AI and Tech, right? So it's going to have AI and technology companies. In terms of crypto and Bitcoin, you have SEPI, which is more, you know, crypto companies put together here. A lot of big name technology companies as well. This could be a good option if you're looking for technology, maybe with a bit of crypto. Yield Max has one as well. I believe the Yield Max one, by the way, are weekly payers, but of course it's Yield Max. So expect very, very high income, but a lot of capped upside. And then Bitcoin, which is about 82,000 now, which is, I was very surprised. I was surprised that Bitcoin didn't drop to like 50,000. I thought it would sell off because it's considered more riskier, right? The riskiest type of asset. But it stayed pretty strong. It stayed pretty much in tandem with the NASDAQ 100. So very impressed. If you want a Bitcoin only covered call ETF, there's YBTC with weekly distributions. Neos has one as well, BTCI. Both of them have extremely high distributions. Then there's Maxi, which they're not really doing covered calls on Bitcoin, but it's a Bitcoin income ETF. So they do call spreads on different things like indexes while holding Bitcoin futures. So obviously, if there's a lot of pressure, you see that in the last 3 months, Maxi is down significantly more than the actual. Oh, I forgot about YBit. YBit is the Yield Max Bitcoin covered call ETF. And of course, again, guys, same story. Yield Max is doing the best out of all of them in the last 3 months because they write the most covered calls, obviously, right? But over time, will that work? Probably not, right? It'll probably give you the most income, but if Bitcoin goes up and up and up, you'll have less total return than the other two. So it's a crazy, crazy time, everyone. Take advantage of it. Buy as much as you can, especially if you're an income investor like me who pretty much sticks with the indexes. Yes, I invest in Canadian listed ETFs, but the equivalent are on the US market, right? You pick your S&P 500, NASDAQ 100, Russell if you want, that you really like, and you stick with it and you keep averaging down. You're still buying the whole market. It's never a bad thing. And this is where the covered call ETFs shine. As we saw, they're all beating the S&P. They're all beating the NASDAQ. Why? Because those covered calls are cushioning that downside. And it might be short-lived, guys, right? So, I mean, this Trump tariff nonsense might soon come to an end once these deals are made. So if you're waiting, if you're holding on to your cash, don't do that. I would not recommend doing that. Now's a great time to invest as much as possible, average down, because today is April 11th. The market's up almost 2%. It might already be too late, but as an income investor, I just keep reinvesting as much as I can every single month. So give this video a thumbs up, guys. I'm out of breath. I would really appreciate it. Please subscribe to the channel as well. We're trying to hit 100,000. We're almost there. We're about 6,000 away. I would really appreciate it. We're going to do this again next month. I'll always keep you informed and covered on how these covered call ETFs are doing. Take care, everyone. See you next time.